I can't believe. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, what Vanguard said is outright shocking. And when you put it in context of what's going on in the global economy right now, you're going to be amazed that they could make such a bold statement. Plus, we're seeing an entire region of the global economy go from bad to worse, and at the same time, can hope keep the U.S. manufacturing sector alive. And if you're wondering what we're doing in the UK today, well, policymakers said this couldn't happen. We told you it would. And now it is. Let's go over to Bloomberg, where we picked today's story up with a headline. The UK is losing jobs at the sharpest pace since the pandemic. And now, wait a minute here, because we've been hearing from all the policymakers and all the politicians around the world that the labor market was strong and robust, and that virtually nothing was going to bring it down or even cause a mere slowdown. In fact, the bigger concern was that the labor market was going to lead to a wage price spiral, causing inflation to go higher, meaning the central bankers actually wanted to see a little bit of a slowdown in the labor market. And yet we said it's only a matter of time before we start hitting the wall. And now the UK appears to be the first. Employment fell 82,000 in June to August after a 133,000 drop from the period from May through July. This according to the Office for National Statistics. It was the third consecutive three-month period in which employment has fallen compared to the previous 3 months, the worst stretch since early 2021. Now remember, this isn't supposed to happen. There's supposed to be so much robust demand, and we continue to make the case that the pandemic stimulus in the U.S. is drying up. The higher rates are pushing minimum payments of credit cards higher. Then even though the policymakers have said, hey, we know the student loan repayments restarted, but we don't see it having any effect on the economy. We said it will, and now we're starting to see the beginning of what will be a global, and it will spread across the world, where we're going to see layoffs from every major economy. The broader picture shows the labor market is loosening, reducing the upward pressure on wages that concern the Bank of England. Some economists are now concerned that the rise in unemployment threatens to tip an already stagnant economy into a recession. Well, of course it does, because that's what going on unemployment already does. It's not like that unemployment benefits are 100% of whatever your pay was, plus all of your overtime. It's not how it works. You get less money. And in a period where consumers, and also businesses, but of course they don't go on unemployment, but you think about consumers, they go on unemployment, they've got a massive amount of debt that's now at higher interest rates, and what is going to happen as a result? Less discretionary spending. It's as if the policymakers don't understand. When you have less money, you spend less, but no, they don't get it at all. And here we can see, looking at the U.S. data, which we've been making the case, this is coming. Here we have total compensation in blue. This is the average hourly earnings multiplied by average weekly hours for production and non-supervisory employees. And we've been making the case is that when total compensation growth slows, and it slows enough that usually layoffs are following. So what happens here, we have the 4-week moving average of initial claims overlaid. And sure enough, what do you see here? Even back in the 1960s and the 70s, what do you see? Slow down total compensation, unemployment claims go higher. You see it here in the mid-70s. You see it here in the early 80s. How about the 90s? You got it in the mid-90s, the early 2000s, the global financial crisis. And right now, we're not quite seeing it, but you'll notice, looking at this chart, the total compensation growth hasn't slowed quite enough. It's close, but we're not there yet. And perhaps we'll get some data here on Friday. Maybe we'll be at the tipping point. We'll start to see it further decelerate, but we could be a matter of weeks to even a couple of months away from seeing a further deceleration in total compensation and that eventual pickup in the 4-week moving average of initial claims. UK now happens to be the first, but normally this will bring inflation down. There's absolutely no question that's exactly what happens, because when you think about it, when people have less money to spend, what do? They go tap their credit cards. And what do we see? A big jump in revolving debt. Now, at some point, they hit the ceiling. That means their credit cards are maxed out or near maxed out. And consumers, when that happens and the banks won't extend more credit, they start to cut their spending. That brings the consumer price index lower. And here you can see on this chart, we have the total compensation now overlaid against the consumer price index. That's shown in red, both on a year-over-year rate of change. And lo and behold, what do we see? Almost perfectly, when total compensation goes down, what happens with a lag? This consumer price index follows. You see it here leading the dot-com bubble. Total compensation down, consumer prices follow. How about in the global financial crisis? You got it. Happened again. Going into the pandemic, remember, we had a global slowdown that was likely headed to recession. There you go. And now we're seeing it again. The only difference here is policymakers actually believe, they're convinced that we're going to see a resurgence in inflation. But if people don't have the money to spend, it doesn't matter. They can't go out and spend money they don't have if the banks aren't extending credit. Of course, we know due to the inverted yield curves and the inverted money curves, banks are tightening lending standards, so they can't give consumers a whole lot more credit before they get nervous that they're not going to be able to pay it back. But now let's head over to the Eurozone, because things here have gone from bad to worse. And I think what's happening in the UK is a leading indicator now of how this unemployment wave is going to start spreading across the world. As Eurozone edges closer to a recession on slowing business activity, the S&P Global's Purchasing Manager Index slowed to a 3-year low in October, dropping to 46.5, clearly below the 50 mark that separates expansion and contraction. Economists expected a slight improvement to 47.4. And you might remember last month when we looked at the data, it was very optimistic. Said, hey, look, there's a turnaround. Everyone was excited. This is a soft landing. It's happening in Europe. And we said, hold on. Take a breath here. Maybe we get a couple months of good numbers, but if this thing rolls over, which we've made the case, and we'll show you again, that is highly likely to turn down, and now it is. And the problem here is when you get these numbers at 45, remember it's at 46, so we're not there yet, but when you start to get to 45, you're at recession level territory. Below that, well, that's where the German economy is at, deep in almost depression level territory, but it's bad news for the economy. In the Eurozone, things are moving from bad to worse, on a headline that only we could use. We wouldn't be caught off guard to see a mild recession back in the Eurozone in the second half of this year, with 2 back-to-back quarters of negative growth. And look at the optimism here. Oh, we're only going to see a mild recession. Again, where is the demand coming from? It clearly is not going to come out of the UK. How about the US? Well, we've got the US data coming here in a bit, but notably, it's not coming out of anywhere because all this stimulus money from the pandemic is gone, or pretty much almost gone. When you take that away and banks aren't extending credit, well, demand has to go down. The currency block's economy faces several headwinds, including a rate hiking campaign by the ECB and a slowdown in global activity, rising energy prices as a result of the conflict in the Middle East, exacerbating its difficulties. But here's the key part, and finally, we get somebody who admits what's really the truth here. Banks in the Eurozone tightened credit standards further in the 3 months through September due to higher borrowing costs and worsening economic backdrop. And that's the case. I've been telling you, this is all that matters in a debt-based economy. If the banks are willing to extend credit, you get growth. They're not, they're going to cut back. And at some point, we're going to get the data out of the U.S. banks. Many people hoping, they're going to ease and they're going to start coming back and lending. We're saying no, they're going to continue to tighten. And why is it? It's not just because the curves are inverted. Now, we know that's the big driving reason. The second reason they tighten credit conditions is simple. They don't believe people are going to pay, so they don't give them credit, hoping they start making payments back immediately. And that's the risk, because here we can see, looking now, we've pulled up the Philadelphia Fed General Diffusion Index. This takes a look at the manufacturing sector in Philadelphia. And what do we know? That's in red. And we've got that against the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. And lo and behold, what happens when banks tighten lending standards? Sure, you can get economic growth for a while because, granted, there's still money in the system. And then look what happens. It comes crashing down. And then there's a rebound. But nope, doesn't last. How about here in the global financial crisis? Here's hope. Hey, hope is saying we're going to have a rebound. Banks saying not a chance, came crashing down. And here we have it again. Hope. Hey, there's a soft landing. The central bankers did it. We're about to see the revival of the U.S. economy on the backs of a robust labor market. Banks are saying no way, Not going to happen at all because there's just not enough money to sustain growth. And I think that's the issue that people understand is money gets eviscerated in our system when a principal payment is made against a loan originated by a commercial bank. So as we see loans get paid down and there's not enough new money being created, well, there just isn't money to sustain equity markets. There isn't money to sustain the economy. There isn't money to sustain inflation. And that's why it goes down every single time when the Fed inverts the yield curves. October's PMI downturn was broad-based across the euro area, as S&P Global said. Indicators based on business surveys in the currency bloc's top two economies, France and Germany, remain well below the 50 mark, and the contraction affected manufacturing as well as services in both countries, which we said, where manufacturing goes, services follow. Everyone else is like, no, this time services leads manufacturing. Well, it didn't, just as we said. More weakness also surfaced in the labor market, a relatively bright spot until now. And so here you get the early indication there's issues in the labor market, but there's one thing that should be experiencing a bright spot, and that's your trading account. Let's take a look at one of the trades we recently featured on our show. And back on Sunday, we showed you how to make this trade. It was simple. October 11th, what happened? Our CTA Time Pro said, we tell our subscribers, watch for this. When it's at minus 100% and it short covers, and you see this minus 55 on the fast or the slow, and we got it on both. There's your first signal. Second signal, go to Momentum Timer Pro. Separate subscription, you see a 1 count on the daily buy. Of course, we know CTA. This is a machine positioning report. This is our technical momentum indicator report. When you see them together, that's the signal to buy. And here's the good news. I'm now giving you on both reports 1 month free. There's 5 coupons a day for them, so you got to grab them before they're gone. If you miss them, go tomorrow. But now let's take a look at if you would have taken those together and you would have bought. You bought this little green candlestick right here, and yes, it went down the next day, but right now you'd be up 3.5% on your trade. And that, my friends, is the power of using our CTA Timer Pro and Momentum Timer Pro reports. There are links in the description. Use a coupon code, get a month free, get some good trades, and you'll see it'll pay for your whole year's subscription. And now let's talk about the services sector, because it could use some little boost from our reports too. As services providers hiring came in almost to a standstill. Wait a second, that wasn't supposed to happen. Manufacturing companies are not just continuing to cut staff, they're ramping up job shedding plans. Now, wait a minute. We were told the manufacturing sector was going to have a revival. They were going to come back and hire. And we said there's no demand. And they said the services sector was the demand. And we said it's not how the world works. And sure enough, the world works the way we said. And now manufacturers are having to lay off. We told you how it would work. When they run out of new orders, then what do? They hit the backlogs. What did we talk about last month when we looked at these reports? They are chewing through the backlogs for over a year. At some point, the backlogs get caught up. There's not enough new orders. You've got people staying around. There's no other choice. You put them on the unemployment line. This led for the first time since January 2021 to an overall decrease in employment. A gauge for the UK showed output was still contracting in October, with businesses more pessimistic than any point this year, prompting hiring freezes, and as we already showed you, staff cuts. And sure enough, we've told you, we know this was going to happen, because let's go back to that Philly Fed, that manufacturing diffusion index, and what do we now overlay the 4-week moving average of initial claims? And we're going to go all the way back to the 1970s. And look, when U.S. manufacturing goes down, unemployment claims go up. You see it here again, 75. You see it in the 1980s. You see it here in the second recession in the early 80s. How about the late 80s, early 90s recession? Got that one too. Dot-com bubble, global financial crisis, both of them. And now look, why did we see a dip in initial claims? Because there was this hope of a rebound in the manufacturing sector. It's coming back down. And what does that tell us here over the next couple of weeks and maybe the next couple of months? What should we likely expect to see is an increase in those initial claims data. We'll watch that, because if that starts to move higher again and go into the holiday season, that means less discretionary spending. You're going to have a lot of goods sitting on shelves that are going to have to get discounted. They're in further what we're going to see, more disinflation, then we get to outright deflation. German data points to another recession and confirm the widely held view that we'll also suffer a full year contraction. Germany is kicking off the final quarter on a sour note as manufacturing output continues to fall at a steep rate. And activity in the services sector, which grew last month, swung into the red again, just as we said it would. And you got to think that German manufacturing sector is already in a depression. It was only a matter of time before it dragged the services sector down. Then unemployment will go up. And next thing you know, demand will continue to go down. And it will just spread further and further around the world. But the question now remains is, can hope keep the U.S. manufacturing sector alive? Well, I don't think so. As U.S. PMIs print Goldilocks surprise in October, growth and expansion slowing inflation. This from Zero Hedge. As despite a plunge in hard data in recent weeks, the S&P Global Soft Survey data shows expansion for U.S. manufacturing and services, while both were expected to decline. Of course, we agree with the expectations here. But look, sure enough, manufacturing came in at 50. This is the estimate, suggesting that it's unchanged from last month. So that's not exactly growth. How about the services PMI? That's at 50.9, now from 50.1 before. So all that tells you is the services sector expanded very slightly over last month. Nothing to get really too excited about at the moment, but let's look at some of the details of these reports. As hopes of a soft landing for the U.S. economy will be encouraged by the improved situation seen in October, the S&P Global PMI survey has been among the most downbeat economic indicators in recent months, so the upturn in U.S. output signaled at the start of the fourth quarter is good news, as future output expectations, or hope, have also turned up despite rising geopolitical concerns and domestic political tensions climbing to the highest for nearly 1.5 years. Of course, this is what hope is about. When manufacturing, when these survey takers start to believe that things are going to turn around, the question we ask is, do you actually have a reason to believe you've got orders coming in the next 6 months, or are you just hoping you have orders coming in because you took on too many people, you overstaffed, and now you're facing having to lay people off again when you don't want to? But here it is. This is the hope. This green circle. Well, you know what? We had our own circle because going into, of course, the pandemic, there was hope until there wasn't, and that is not unusual. The data is kind of messy, but we'll make the case, of course, why hope is only going to be a fantasy, that now from manufacturers and the Fed. As the survey selling price gauge is now close to its pre-pandemic long-run average and consistent with headline inflation dropping close to the Fed's 2% target in the coming months, which we said was going to happen, something that looks likely to be achieved without output falling into contraction. That said, tensions in the Middle East pose downside risk to growth and upside risk to inflation, adding fresh uncertainty to the outlook. But sentiment has improved in part due to hopes of interest rates having peaked, something which looks increasingly likely given the further cooling of inflationary pressures witnessed in October. So now we get a kind of a snippet of what these purchasing managers were looking at when they filled out the survey, is they think that somehow if interest rates don't go higher, demand is going to go up. But that's not how it works at all. It's about the banks. In spite of higher oil prices, firms' input cost inflation fell sharply to the lowest since October 2020, and average selling prices for goods and services posed the smallest monthly rise since June 2020. But here we now get into Vanguard, because now I wanted you to go through all this and see where the pulse of the global economy is going, because what we can see is it's shrinking, and that's the key part. Manufacturing is leading services, services are leading to unemployment claims, and I want you to see that's going to be the narrative all over the world. And that's what makes even more surprising what Vanguard just said. As Vanguard says, debt investors dreading rate drought, well, they're missing out. The world's second largest asset manager, overseeing $7.8 trillion globally, expect interest rates to remain higher for longer and project a shallow recession around mid-2024 and minimal room for high-grade spreads to tighten. So they're not even seeing much of a recession, a shallow recession. See, that's it. A lot of people don't understand. You curtail the creation of credit in a debt-based economy, you get a recession 100% of the time. It's not mild. It's going to be worse. Still, the Federal Reserve is nearing the end of its hiking cycle, and investors are better off locking in higher rates for longer by loading up on corporate bonds, the firm's fixed income team said in a note seen by Bloomberg. The question is, why would you invest in corporate bonds? It doesn't make any sense, because if you look at the equity market, when it starts coming down under tighter financial conditions, we know that demand goes down also from consumer spending. That means corporates get squeezed at the margin. They're going to have to lay off. So the idea that these bonds are safe, well, that doesn't make any sense to me at all. And the outlook for these notes isn't looking too rosy. The 10-year Treasury will briefly cross 5% for the first time in 16 years this week, and the Fed is leaving the possibility of future hike open if policymakers see further signs of resilient economic growth. The higher the duration, the more sensitive the bonds are to central bank actions. Of course, that means when rates go back to zero, we know that's going to happen. That means the value of those bond prices is going to skyrocket. And sure enough, we can see this because the way the monetary system works, and this is really important as we look at the next slide, is when there isn't enough money being created in the economy, rates do go down. It doesn't matter if people are shorting it or selling them. Eventually, rates go down. Now, historically in the cycle, we see rates fall, as you can notably see during the dot-com bubble and the global financial crisis. This cycle, we have what was likely a new generation of traders that have bought into the Fed and that rates must go higher and that inflation is perpetual. And all they're going to find out is unless the entire system starts to outright collapse, which it can, that rates will start to come down, and they will come down rapidly, because if you want money to be created, you need interest rates to fall. And the simple evidence is, are we seeing more loans originate at a higher rate? The answer is no. So that means the system every day gets closer to a breaking point. At some point it happens, and you will watch rates nosedive right back to zero, because they've got to go below where they were before to incentivize people to borrow. And yet the deficit doubling as the U.S. economy grows shows why yields are at 5%. Again, here's more misinformation put out. No, the reason yields are at 5% is because the Fed jacked up the front end of the curve and they've artificially manipulated it. The reality is, if the market was controlling the front end of the curve, I imagine rates would be nowhere near as high as they are now. And the surge is a powerful illustration of the fiscal path that's triggered warnings from economists, politicians, and credit rating agencies. It also helps explain why yields on longer-term treasuries are reaching new highs. And no, it doesn't, because Powell said, if you drive rates higher, I won't raise the funds rate. And what happened? People shorted it. The unseen before the global financial crisis, the next one's coming, with the government needing to reissue even more debt to cover the shortfalls of revenue relative to spending. And that's what's going to be baffling to people, is when they find out that this debt will be bought time and time again, because there will be so much demand for it. It will cause rates to come crumbling down, because this notion that you add more debt, here's a federal total public debt, that rates have to go higher. Well, why now? Why hasn't this relationship happened until now? The reality is there isn't one, because when the government crowds out the private sector from the economy, rates have to go down, because the private sector isn't creating enough new money to sustain it. Rates go down, just try to spur more demand. That's how it works. That's why the relationship, more debt, lower rates. But the Fed still won't likely be paying the Treasury, and Treasury is going to be paying higher and higher interest on its debt for some time. That's created a vicious cycle, because the higher interest costs only add to the deficit, requiring more debt to be sold. Of course, many of you would say, hey, we need to cut the deficit, need to cut it down to nothing. Well, as much as that we'd like to see that too, we'll put that in the list of fantasy things, along with central bankers thinking we're going to get a soft landing. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.